Hi everyone, I'm the Tax Pro, and today we're on day 18 of our 90 Days to Taxes series, where I'm taking new businesses or businesses that may be disorganized, helping you get organized and ready for tax season. Today we're talking about a form of accelerated depreciation called Section 179. So if you're unsure what depreciation is, go ahead and watch day 17, and I give some information about what depreciation is, how it's calculated, how normal depreciation works. As a reminder, with depreciation, you're essentially allocating the cost of an asset over what the IRS has deemed its useful life to be. Okay, and I explained all this in the last video, how we determine the useful life. But essentially, if, for example, you have a 5-year asset, we are going to take the cost of that asset and we are going to allocate it really over 6 years, because you take a portion of the first year and then you take a portion of a year in year 6. Okay, so we split it up over these 6 years and we allocate the cost accordingly. That's how normal depreciation works. However, there are 2 forms of accelerated depreciation I'm going to talk about. Section 179 I'm going to do today. Bonus depreciation or special depreciation I'm going to do tomorrow. And what these are, this allows you to take all or part of the cost of qualifying property in the year that you place those assets in service. Okay, so in the year that you place those assets in service, you get to take a larger amount. So this is only for year 1. We don't get to elect Section 179 for subsequent years, okay? Downside to accelerated depreciation: you don't get the deductions in later years, okay? So if I purchase $1 million piece of equipment, I take the full $1 million this year. Next year, I don't have the depreciation for that equipment because I used it all up, okay? So it's not like we get to use accelerated depreciation and we get regular depreciation later. You only get regular depreciation for the amount left over after your accelerated depreciation. So there's downsides to Section 179 and bonus. A lot of times I'll see taxpayers not want to think about the downside until it's the following year and they're like, well, I don't have anything to depreciate. I'm like, yeah, we talked about this. Keep in mind, that's what happens, okay? So it's really, really exciting. It's like a shiny little thing this year. You get to take depreciation this year. You get to reduce that tax. Sometimes you get to take it down to 0. Or in the case of bonus depreciation, you get to create a loss, and it's really exciting. You save a lot of money. In future years, though, it bites you in the butt. Unless you have additional assets, you're going to be in a lower tax bracket or something along those lines. Okay, so let's dive into Section 179. As we're going, I'll try to point out the differences between Section 179 and bonus, because you really should, weigh both of them. Okay, so with Section 179, you can elect to recover all or part of the cost of certain qualifying property, up to a limit, by deducting it in the year that you place the property in service. So a couple of things. We can do this for all or part of the cost. There are limits, and you can only use it in year 1. Okay. What property qualifies? It has to be eligible property. There's a definition right here of eligible property. It must be acquired for business use. So this does not count for personal use. Okay. And it has to have been acquired by purchase, and it cannot be excluded property. So eligible property. Tangible personal property. Tangible means we can touch it. It's something that you can see with your eyes. You can touch it with your hands. Examples of intangible would be things like trademarks, copyrights, that kind of stuff. Licenses to use something, okay? Those are not tangible. Personal property. So we just talked about how this has to be for business use. What does this mean, personal property? When we talk about tax definitions, personal property means that it is not real property. Real property means real estate. Okay, so when you see real property, think real estate. It doesn't mean like we have real and fake. We have real and personal. Real is like real estate. Personal is not real estate. Okay, so tangible, so we can touch it. It's personal. It's not real estate property. Other tangible property, except buildings and their structural components. In general, you cannot depreciate, or you cannot take Section 179 on buildings and structural components of those buildings. Okay. I'll let you read through this because a lot of this isn't going to apply. Single purpose agricultural and horticultural structures, I want to point out, and then off the shelf computer software. I'll explain what off the shelf computer software is here in a minute. There are certain qualified Section 179 real property items, which I'll show you here. Okay, tangible property. This is going to give you tangible personal property. This is going to give you some information and some examples. Okay. Notice portable air conditioners or heaters and certain property used predominantly to furnish lodging or in connection with the furnishing of lodging. Off-the-shelf computer software. So that can be kind of confusing because, like, for a lot of people, I mean, you're like, well, that's intangible, right? And it is. But off-the-shelf computer software does qualify for Section 179. What it means by off-the-shelf is it's readily available for purchase by the general public. It is subject to a non-exclusive license, and it has not been substantially modified. Okay. Section 179, qualifying real property. There is certain real property that qualifies. There's a specific section in the Internal Revenue Code. Notice that any of the following improvements to non-residential, I want to highlight that this is non-residential, so commercial real property, roofs, heating, ventilation, and HVAC, or in air conditioning, so HVAC, fire protection and alarm systems, and security systems. Generally, you cannot have qualified, or generally you can do qualified improvement property, but that cannot include enlargement of a building, an elevator, an escalator, or any internal structural framework. So anything that attributes to the structure of that building is not going to qualify. It has to be acquired for business use. If it's partially used for business and partially used for personal, you have to use it for business at least or more than 50%. Okay, if it drops below 50% in later years, you may have to recapture the Section 179. What that means is you then pay tax down the road on the Section 179 that you took on that asset. Has to be acquired by purchase. That's self-explanatory. What does not qualify? Land and improvements do not qualify. Okay. In general, we cannot take land anyways. We don't depreciate land. Land improvements, we do depreciate. But land improvements are, this gives you examples. Swimming pools, paved parking areas, docks, bridges, fences. These don't qualify for Section 179. This is accepted property, so items that just don't qualify. Okay, how much can you deduct? So we've determined what assets we can take Section 179 on. And the assets that you can take Section 179 on are not the same as the assets that you can take bonus on. Bonus generally covers more than Section 179, okay? Section 179 tends to be more limited than bonus. Section 179 is also an election, whereas you elect out of bonus. So you elect into Section 179. Bonus depreciation is automatically applied and you have to elect out of it. Okay. Now there's limits on the total amount that you can deduct. There is a dollar limit for the total Section 179 deduction and the value of assets that you put in place. And then there's also a business income limit. So let me explain the dollar limit first, and then I'm going to go over the business income limit. Okay. So for tax year 2024, you can deduct up to $1,220,000 on Section 179. I will show you for tax year 2025 what that amount is. For tax year 2024, it's $1,220,000. But there is a phase out. So if we go down here, you will see cost exceeding $3,050,000. So once you put in qualifying Section 179 property, if you have $3,050,000, up to that point, you can only take this 1,220,000, and I'm talking about tax year 2024. I'll show you the 2025 limits. Once you hit 3,050,000, any dollar above that reduces the amount dollar for dollar of what you can take. So let me kind of explain this. It has a really good example here. So Jane Ash placed in service machinery costing $3,100,000. This is $50,000 more than this limit, okay? So she can take this maximum of 1,220,000 and she has to reduce that by 50,000. So this is the new limit that she can take for her Section 179 deduction in 2024. Okay? So if you end up placing in 2024 $4,270,000 in qualifying Section 179 property into service that year, you can't take a Section 179 deduction. At that point in time, the Congress decided you are able to purchase too many assets, your deduction's phased out. For 2025, the limit goes up a little bit. So instead of this 1,220,000, we now have 1,250,000. The point where it starts to phase out in 2024 was this 3,050,000. Now it's 3,130,000. Okay, so this is modified for inflation. This means that once you hit for 2025, once you hit $4,380,000 in Section 179 assets put into service, you can't take Section 179. Okay, so that's the dollar limit. We also have an income limit to Section 179. The total cost of your Section 179 deduction, that total amount that you're electing to take, cannot create a loss. Okay, so it can't be more than your business income. This is a difference between Section 179 and bonus. Bonus can create a loss. Section 179 cannot. However, any cost that is not deductible in 1 year under Section 179, because of the business limit, it can be carried to the next year. What that means is, let's say I have $1 million in profit in my business, but I have, $1,200,000 or $200,000 in Section 179 that I want to take. So I have $1 million, but I have 1.2 in Section 179. I can take the Section 1.2, but that 200,000 is not deducted in that first year. It gets carried into the following year. Okay, so I know I said that you can't take Section 179 in future years. You can, however, take it and then carry forward if it's limited because of the business income limit. Okay. So, and this explains the different business taxable, or the different business taxable income limits. There are also some deductions that happen on the owner level. The owners themselves have limits. So when you take Section 179, if you have a partnership or an S corporation, the Section 179 is not immediately taken on that tax return. It gets added as a separate line item on your Schedule K-1. And the reason being is because the partner also has limits. So the partner or the shareholder has personal limits. It cannot create a loss. So it's going to go in and it's going to explain the personal limits for partners and shareholders of these businesses. That Section 179 gets carried forward on your personal return, and then it gets combined with other businesses that you may have. So if you have a bunch of different businesses and all these businesses are electing to take Section 179 deductions, you might not be able to take those on your tax return, okay? So when we consider Section 179 deductions, we have to consider them on the business level as a whole, and then we also have to consider them on the business owner level, because the business itself has limitations, but so do the owners in that business when it comes to partnerships and S corporations, okay? And this publication 946 covers those limits. Let me scroll down to this S corporation. So you'll see here, generally the rules that apply to a partnership and its partners also apply to an S corporation and its shareholders. Other corporations are different. C corporations are a little different. Let me pull up a Schedule K1 and I'm going to show you where this sits on your Schedule K1. Okay, so here is a Form 1065 K1. So this is the partnership K1. It's going to look very similar to the S corporation K1. You'll notice on line 12 is the Section 179 deduction. So what'll end up happening is the partnership will put the business income or loss before the Section 179. So this partner's share of the ordinary business income or loss before the Section 179 deduction. And then it will include this partner's share of the Section 179 deduction. So the partner is going to be subject to Section 179 limits, just like on an aggregate basis. Okay, so they're going to be stuck with these limits as well. Okay, so this 1.22 or this 1.25. They are not necessarily subject to the spending cap, but they cannot create a loss. So they can only take a Section 179 deduction up to the aggregate business income that they have, okay? So it's going to be calculated a little bit differently on their tax return, the limits, than on a partnership or an S corporation's tax returns, but they have limits on their personal as well. So if they end up with too high of a Section 179 deduction in these businesses, then they would carry forward that Section 179 deduction on their personal return. So you can carry it forward in multiple areas. It's kind of complicated. Okay. This is going to explain how do you elect the deduction. This is taken on Form 4562. I went over this form in the last video. This is the depreciation form where you calculate that depreciation. This form would be filed with the partnership return or the S corporation return or the C corporation, or it's going to be in connection with the Schedule C. So each business files this form. Okay, so that is the Section 179 deduction. Next, I'm going to go over the special depreciation for the bonus depreciation. I'm going to have a completely separate video for that because this one's already almost at 20 minutes. These are a little bit different, okay? So bonus is a little bit different than Section 179. Section 179 is a great tool. It just does have some potential repercussions, especially in future years. So keep that in mind when you're looking to see, does bonus or Section 179 make sense for you? If you have any questions, please let me know. If this was helpful, please consider liking and subscribing, and I will see you guys next time.